All right, in the interest of time, I think we will get started. Today, we will be covering the following agenda. You can see which we have on screen: assembling your team, preparing for practice, tax planning itself, future cash management, practice structure, and then some other useful information. And we will have some time at the end if there are questions, so don't hesitate. Mustafa will act as our moderator and we'll make sure your questions are posed. All right, let's get started. All right, the first item to consider as you're new to practice, and so oftentimes people who come out of residency or finishing fellowship don't quite know where to start, and perhaps the best place to start is by assembling a team. And who's on the team? Well, you'll need a banker, and a bank, an accountant, somebody who deals in insurance, so managing the risk of your practice, and then legal. And if you're looking for a place to start, feel free to go on to tuckersbc.ca, our website, and you will find on our professional advisors page a list of professionals dealing in certain areas like banking, insurance, and law. Now, let's talk about a bank to start with. There are a few banks which deal just in healthcare professionals. You will probably have seen presentations from RBC, from Scotiabank, and Bank of Montreal. Those are the ones that I see most frequently. And so they will have their own teams of healthcare professionals. And so those banks typically are who I see making offers to healthcare professionals at various stages in their career. Sometimes I will hear people say, well, you know what, I get handed off from one person to another, or I don't have a contact, I go into my branch, and so that's how I deal with banking. And if that's your experience, you're not dealing with their healthcare department or a healthcare contact. You need somebody inside the bank itself who can help you navigate these large institutions. And so that's why I say here, find an individual contact within one of these banks. If you have difficulty finding someone, reach out to me and I will connect you with someone who can assist you depending on where you're at in your career and so on. But I would suggest you get somebody who you can pick up the phone and call when you have a need. I need to open a bank account. I'm now starting a professional corporation. I need an investment account, what have you. But somebody on the inside who can help you navigate these large institutions. You should also, if you haven't already, consider opening a separate business bank account. And so that will be useful in terms of keeping track of your actual billings, your sources of income, and also making your payments out of that. Why set up a separate business bank account as a sole proprietor, which is what you are if you haven't incorporated? Because if you get audited with CRA, it will be much cleaner if you simply have a separate account where all of your practice-related expenses have been tracked. So that's my suggestion in terms of just actually opening a bank account. And then as you're trying to discern who you want to bank with, if you find yourself in a situation where you haven't got a bank, one of the questions I encourage people to ask is the question you see on screen. I'm starting my practice. Why should I deal with you? What will you offer me? And I would check with each of the banks that I've mentioned, RBC, Scotiabank, BMO, and talk to somebody on their healthcare team and put that question to each of them and see what you feel after you've heard their response. If you've incorporated, the last bullet on screen talks about not taking a corporate credit card. I'll leave that for a little bit. But what I would say, and we'll get into this a little bit more, is in terms of tracking expenses is what I will explain when we come to that slide. All right, we've talked about a banker. We know you need an accountant. Next, an insurance advisor, somebody who can help you deal in the risk areas of life. I'm not just talking about practice-related areas like your long-term disability, which is critical for you to have if you don't have long-term disability or if you haven't bumped it up since going into practice. you need to do that. I encourage people to each year make sure they review their insurance. And if you're with a reputable insurance broker, they will usually reach out to you after April. Typically is when I find we get a lot of inquiries. That's after people have filed their taxes, and so then the most recent income information is available for long-term disability increases. So make sure that doesn't go unchecked. You do not want to find yourself in a situation where perhaps you've had an injury or an accident or a career limiting injury or illness and not have an income replacement for that. There are two forms of coverage depending on what your needs are. One is income replacement. That's just simply to replace the lost income. You will not get the same amount of income as you're used to earning. Insurance companies are not interested in giving you what you were earning. There's no incentive for them, and so they want to create a situation where there's disincentive for their clients to take advantage of a situation. But so they will typically pay you somewhere between 66 and 70% of your income. Why is that? Why don't they give you 100%? Well, because in most cases, payouts from long-term disability policies are free of tax. And so if you had continued to work and had received income, you would have paid tax on that income. However, under long-term disability, as long as you haven't claimed the premiums or deducted the premiums in some form or other, the benefits that are received from that policy are tax-free. In other words, then you will end up typically in a situation similar with a similar level of income as you would have had you been working. So that's the reason that there isn't a payout commensurate with what you've been used to earning. After tax would be equivalent to what the amount of the disability payout is. Now, that's practice-related areas. There's two types of long-term disability income replacement. The second there is office overhead if you're running an office. Now we get into the health risks side of things, and that's where you run into critical illness as an option. So something happens, you get a one-time payout typically, and then health and dental. There are many places to go for health and dental coverage. One of them is Ontario Medical Association. They have an OPIP Plus plan, which is a fairly comprehensive plan. It's subsidized by the government. In other words, you're not paying the full shot on health and dental coverage in that plan. So you might want to take a look at that. So that's OMA OPIP Plus. So those are the health risks. And then we get into professional liability. Well, if you're a member of CPSO or any of the provincial regulatory bodies, then you will have malpractice insurance under CMPA. And so that's where your professional liability coverage exists. And then we get into estate planning. This is where we're talking about life insurance as people typically think of it. And there's a couple of different types of life insurance. One is term. You will have had that if you were a member of CARMS or not CARMS, but PARO. If you're a member of PARO, while you were a resident, you had coverage. You may be able to transfer that now that you're into practice. And then you've got to look at other sources of income or other sources of insurance. And there's term, and there's what's known as universal life or permanent insurance. Generally speaking, early in career, you're probably not going to want to look at whole life or permanent insurance. You're probably going to want to look at term, which is your cheapest. And in that case, you're just buying a contract for insurance to cover in the event of death. That's particularly important if you have a young family or dependents, people that are relying on your income for part of their life. And so that's something not to ignore. All right, so that's insurance. And then we get into law. Now, this is oftentimes I find with new to practice physicians, they are facing legal issues they aren't even aware they have. Maybe it's just you've moved in with your partner and you're in a common law relationship and you haven't really thought about the legal implications or the economic or financial implications of that union. But it's something you ought to be aware of. In common law situations, those are typically addressed with a cohabitation agreement. It is not the most romantic topic to discuss, but nonetheless, it's something that needs to be addressed. And so the mechanism that lawyers use to address that type of situation is a cohabitation agreement. Now, I'm not a lawyer, I'm not giving you legal advice, but I am using that as an example just to point out to you the fact that you may not have thought of legal issues, but there are legal issues all around, and you need to be aware of them. The second might be you just bought a house. Maybe you bought it with your partner. Again, who owns the house? What kind of agreement have you come to in the event of the sale of the house? Or what if something would happen to either one of the parties who own it? Well, that's another example of why you would need to seek out legal advice. Or maybe you've just received an offer of employment from a hospital and it's 20 pages long and you're not quite sure what to make of it. What I always say to people is get a lawyer to take a look at it. Typically, if you're getting a contract or an offer of employment or an offer from a hospital, you are not going to be able to negotiate any of the terms in that agreement. It's a master agreement. If they change it for one, they would have to change it for all. And so that's not going to happen. But what you do want to be aware of is the terms and conditions in that contract and how they affect you. So it is well worth having a lawyer spend an hour and just go through it with you and summarize the highlights and to make that document more accessible and understandable. And then in the event of death or injury, we get into the topics of wills. Now, oftentimes when new to practice physicians get started, they don't have a lot in the way of assets to convey in the event of their death. But that isn't always the case. If there's, for example, a young family where there's kids, then that is something that needs to go to the top of your priority list to put a will in place. At this point in your career, you're probably not thinking about multiple wills. And why would I need multiple wills? Don't I just need a will? Well, no, actually, typically, most healthcare professionals will have two wills. They'll be enforced at the same time. One is a primary will, one is a secondary will. There are reasons around probate fees to have a second will. But that is something you should be aware of as you look to have your wills prepared. I won't go into the purpose of a multiple will at this point. It's a little bit involved, but it is intended to have a second will to save on the cost of probate later on down the road when an estate is in the process of being administered. And then, of course, there's a power of attorney as well. So in the event of your being incapacitated, then a power of attorney, again, is as important for you now at this stage in your career as it ever is. So make sure you have that in place. And one other tip I say to people, make sure loved ones know where these documents are. Oftentimes, lawyers keep these in their own safes for on behalf of clients. There's a charge for doing that, but at least there's no doubt about where those important documents are. The last thing you want to leave a loved one with in a situation where there's death or injury and incapacity is them not being able to act on your behalf because they don't know where to look for these documents. So make sure that that they understand where you've left them. Another example of a legal issue is entering into a partnership, a FO, or other commercial transactions. You're looking to hire an employee, or you're looking to lease commercial space, or you're getting into a FO. Any of those require a lawyer's assistance, and so that's why I've listed those situations there again to make you aware of some of the issues that are going on in the background as you're practicing. Now, there are different types of lawyers for different career stages. There's a family law lawyer. There can be a need for a commercial lawyer, negotiating a lease or hiring staff or entering into contracts or offers of employment you receive. And so those, and that can also be an employment lawyer as well, incidentally. So my point with this slide, though, is just to simply say that you may not find one lawyer who can address all of your needs. Another one I've listed there is a patent lawyer for protecting anything you're doing with respect to research. Sometimes we find ourselves in situations like that with clients who are involved in research, and that becomes an issue. So using a patent lawyer can be important. I've also put down there just a resource for you to be aware of, which is OMA. OMA, if you're in Ontario, offers free legal service. They are also available for incorporation and review of certain legal documents and templates. They will provide templates or certain legal advice, but there is restriction to their offer of service. And I have heard from some clients that sometimes there's a delay in terms of reaching out to them. I can imagine, since they're offering a free service, that that's going to be a popular service. But it's there nonetheless, so just be aware of that. All right, so we've talked about assembling your team: a banker, an accountant, and an insurance advisor, and a lawyer. Now let's move on to actually preparing for practice or being in practice. What records do I need? How should I keep them? Can I write off my training expenses? Do I need GST to register for GST? This is the next section of today's presentation. So let's take a look at this. So where do I find myself? I'm new to practice. Maybe I've just finished a fellowship or finished my residency. So what are some of the things that I need to be aware of? Some of these will be obvious, others maybe not so obvious or just not known at all. But if you have not incorporated and you are now billing your provincial body for fee for service or getting paid for moonlighting, if you're still finishing up a fellowship or finishing up a residency and you're getting self-employed income, your status for income tax purposes is that of a sole proprietor. That means as you earn your income, you report it on your personal tax return and you deduct your expenses. The form that gets reported on is called the T2125 form, and it's part of your income tax return each year. But you are a sole proprietor, and so that is how, by default, you find yourself once you start into practice. Other things that you need to look at is applying for an OHIP billing number and identifying any other expected sources of income. You may, if you have staff, need to apply for a business number with CRA, and that's if you have source deductions. You have staff and now you start to pay staff. You will need a business number from CRA, and so you'll have to apply for that. Now, this is an area that many doctors, whether they've been in practice for a short time or a long time, are not aware of, and that's their requirement or obligation to register with the government to become an agent to collect GST. And it arises out of some types of income that physicians will earn. Perhaps you're an expert witness, or you're writing an expert opinion, or you're receiving what you'll know as HOC, hospital on-call coverage stipends, or other types of stipends. Some of those sources of income can give rise to an obligation to register with Canada Revenue Agency and to start charging those various sources of income, start charging them GST over and above what you're earning. So this happens oftentimes with HOC fees. That's a good example. CRA has expressed an opinion on the doctor's obligation to collect GST from the hospital you're working at, or if you're working in a long-term care facility, for example, and you're receiving HOC stipends or stipends for showing up. So the way I explain it to people is this: if I'm your patient and you're billing OHIP or any of the provincial bodies for on a fee-for-service basis to maintain or to restore my health, if that's the basis, then that service and the income you're generating from that is exempt from GST. You don't have any obligation to register or to collect GST on that type of income. We've just agreed as a society and at a government tax policy level that when it comes to caring, maintaining, and restoring people's health, that is going to be exempt from GST. But to the extent that you've got other sources of income which might just arise for being available, for showing up, for example, as you get paid for a HOC stipend, then the government looks at that and says, well, hold on a second here. There's no particular patient that you're being paid for. You're being paid to be available. You're on call. And so for that type of income, that's the type of income that can qualify and for which you'll find yourself having an obligation to register and collect GST. Now, when does that happen? Well, it doesn't happen immediately because you might be receiving some form of stipend now or earning income for writing WSIB reports or things like that, on which there can be an obligation to collect GST. But it's once you've reached a certain level of income of that type of income. So it isn't fee for service, we've said that's exempt, but if you're earning the type of income where you're not maintaining or restoring a patient's health, you should be either seeking out professional advice to see if there is an obligation to collect GST or not. Now, let's say there is. Let's supposing you're getting a monthly stipend of $3,000 a month. You don't have to register straight away. Only when you hit $30,000 in the past 4 quarters do you have an obligation then to register and start charging GST. So this is not a tax that should come out of your pocket. It's a value added tax. It's not one that you pay for, it's one that you are paid for it, and you turn around and remit it to the government. And you do that in the form of a GST return. So that's something to be aware of, and I only mention it because it's an area where there's a lot of ignorance on this particular topic. So that's an important piece to be aware of. So that's registering for GST, HST. And incidentally, if you see those two terms, GST and HST, what are they? Well, they're, depending on the province you're in, they're referring to the same tax system. GST is a 5% federal tax that's levied. So when we talk about GST, we're just talking about the federal tax itself. But in some provinces and territories, they also had previously like a retail sales tax. And so what happened was the provinces and the federal government, some provinces and the federal government got together and said, listen, we're running the same type of tax. Why don't we harmonize our tax, federal and provincial? And so that's what you're seeing in HST. HST is an acronym that stands for Harmonized Sales Tax. That means that one government body, the federal government, collects both levels of tax, the federal and the provincial, and then behind the scenes they make payments to the provincial governments for the GST or for the provincial portion of the HST. So if you're seeing that term and you're not sure what it stands for or when to use it, that's what it's referring to. Now, that's it for GST. Let's talk about tracking expenses. This is an important one. If you're not sure how to do this, then you need to pay attention because most physicians don't have many expenses. But what will happen, or maybe you find yourself in this accelerated situation already, it jumped up into the top tax bracket, and you're trying to make sure that you don't pay any more income tax than you absolutely have to. And so it's for this reason that tracking of expenses, both past and present, becomes absolutely important. Now, so let's talk a little bit about this. I'm gonna just jump to the next slide for a second, and we talk a little bit about expenses in the next couple of slides, but they're around living expenses. And this is what we want to talk about here is around business expenses. So we have to wrap our head around, and oftentimes I get asked by new to practice physicians, so what can I write off? And that's actually the wrong question to ask. You might think that's not the wrong question, but really that's the job of an accountant. So what we try to do is give you a system and an understanding of what an expense is. So if I asked any of you on today's webinar, what is an expense, define it for me, I would get a variety of responses. But I always tell clients, an expense represents any purchase you make that has a connection with earning your income. The expense is incurred in the course of earning your income. So that's the first concept you have to think of. And it may seem obvious, but it's not quite so obvious. I'll give you a couple of examples of this. And I had a physician a couple of weeks ago who we were chatting. I asked her how her summer had been, and she said, "Oh, it was great. My husband and I and our kids rented a cottage through Airbnb up north, and we had a great time. My kids had a great time. My husband had a great time, and I was on call the whole time." Well, in that case, because she needed to be available, be in close proximity to that hospital, part of the rent that she was paying for that Airbnb vacation property is actually a business expense. It was incurred in the course of earning her income. She couldn't have been available and on call for that week had she not been in that cottage. She could have been in a hotel, but the cottage served the purpose of keeping her within proximity of the hospital, enabling her to earn her income. And so that's an example of drawing a connection between spending money and earning it. And that's your job. My job, or any job, any accountant's job, is to tell you of all the expenses, the array of expenses that you collect, what can be claimed and what can't be claimed. And so the first thing you need to be thinking of is, all right, as I spend money, is there a connection between this purchase and earning my income? And if there is, you want to track that. Now let's talk about tracking expenses for a second. I have a video on this, which is just dealing with tracking of expenses, but I'm going to give you a quick primer on how to do it. Firstly, CRA needs receipts. These are my receipts for the last couple of days. I emptied out my wallet, but in the last day or so, but I keep receipts for everything. I mean, literally everything. I do it as a force of habit. I may never need these receipts, but my system, which is, I'm similar to you, I'm just in a different profession, but I need to keep track of my expenses. And CRA expects that I will keep track of the receipts themselves. They will not accept a credit card statement. If you pay cash for expenses, you might lose the receipt. So I say to people, use one credit card, at most two, because you're making more work for yourself if you have multiple credit cards. And I have a number of clients who've in the past had numerous credit cards because they get points or things like that. I say keep it to one, at max two. Sometimes if you haven't, like I have American Express and it's not taken everywhere. And so I have to have a backup credit card, but my credit card is my system of maintaining my expenses. So the first thing is keep the receipts. You have to have the receipts. You need to keep them for 6 years. And so you have to have them, and you have to have them readily accessible, because when CRA comes knocking, you have to produce them. So what do you do with these things? Well, here's what I do. A number 10 envelope. Here's my credit card receipts. When my credit card statement comes in, I print it out. Now, you don't have to. CRA will accept a facsimile version or a scanned version of a receipt as long as it's legible. But what I do is I print it out. I go through and I check it to make sure that the expenses listed there are legitimate or valid expenses. And then once I've done that, I take the receipts that I have and the statement and I put it in an envelope. And then on the front of the envelope, I write, depending on the credit card, so I have Visa and Amex. So this is Amex, Visa. This may seem obvious, but I'll show you why I do this. And this is September 2022 plus 6. And this is what you'll see on all of my expense envelopes. Why do I put plus 6? Because I need to keep this envelope for 6 years. So in September 2028, I can throw that out. All right, that's your system for keeping receipts. Now, why do I say use a credit card? Well, use a credit card because the data collected by credit card becomes imperative. try to minimize the items that you're paying cash for if you can, and take advantage of the points that are offered by credit card companies at the same time as using their data collection techniques or their systems to keep track of these expenses. All right, that's a couple of words about keeping track of expenses, how to do it, and also continuing to download that data on a monthly basis is very fast. By the time you've done that, each month your credit card statement comes in. You will have all of your purchases, both business and personal, all in one spreadsheet for the year. You just simply go through that on a month-by-month basis. Shouldn't take you more than 15 or 20 minutes just to identify the practice-related purchases that you've made. What are some of the typical ones? Well, again, the concept is, did I spend this money in the course of earning income? But some of the more common ones, professional dues, auto-related expenses, and when we're talking about that, it isn't just gas, it's parking, it's insurance, it's repairs and maintenance, it's a portion of the purchase price or the lease cost of the vehicle up to a certain limit. So those are the typical expenses that we see with respect to tracking. All right, let's get into now the tax planning. And this is where things have changed once you've moved into practice, because while you're a resident, not usually when you're doing a fellowship, but usually when you're a resident, or perhaps if you become an employee of a hospital, the income tax, the CPP, the employment insurance is all withheld at source. But when you become a sole proprietor, all that changes. The responsibility for paying tax and so on now becomes your obligation. And so you will have to pay that tax. The payment due date, and this is a date you should set aside in your calendar as a recurring entry to remind you each year, is April 30th. So what I suggest to people again is, if you're not used to these dates, then set up on your smartphone, in your calendar, set up these dates. If the payment due date is April 30th, set a reminder for April 15th. Income tax is due April 30th. All right, that's a little bit about staying on top of it. But if you're now receiving $15,000, $20,000, $30,000 a month, and there's no income tax being withheld, a rough rule of thumb I say to people is count on 40% of that for tax. Just set it aside. Now, if you want to be more precise, then you can have an accountant do a tax calculation. We do this all the time so that people have no surprises. If they're using their line of credit and they're trying to pay it down, then this will just give you an idea of how much your line of credit is going to go up next April if you don't have savings to meet your tax. But if somebody's earning, just to give you a rough idea, if somebody's earning $220,000 of income after expenses, that's taking into account all of their expenses, they're going to pay tax of about $85,000. That's tax and CPP. That's a rough idea of how much you're going to pay on $220,000. All right, so that will give you just a rough rule of thumb to go by. How much will I have to pay for installments? So let's talk about installments for a minute. You can see some dates on the screen, so make a note of those dates. Remember, I said to you, make a note of when your balance of tax is due. When I say balance of tax, what am I talking about? Well, let me just remind you, April 15th is the date of that reminder, and then there's 4 other dates here: March 15th, June 15th, September 15th, and December 15th. 4 more recurring appointment entries to go into your calendar. So for March 15th, set it March 1st. For June 15th, set it June 1st. For September 15th, set it September 1st. And December 15th, December 1st. So what's with installments? Well, this is an area of great confusion. But think of it this way. Up until recently, you were a medical resident. Income tax was being withheld at source. Maybe you still had some tuition credits left over, and so when you filed your income taxes, you owed the government no money. And so all that will change if it hasn't already for you, because now nobody's withholding tax. The government isn't getting your money on the income you're earning. And so the government says 2 things. Firstly, we want your money, so we may ask you for installments. And secondly, they may say it's a matter of equity. If your next door neighbor is earning the same amount of income you are, as an employee, they're paying their tax as they go. And so therefore, it's not fair that you should have the use of your money for up to 16 months, which is in some cases the situation. And so the need for installments became a matter that CRA had legislation written around in the Income Tax Act. So you can see those payment due dates, and the thinking is this: if you're not having tax withheld at source on the income you're earning, then we want you to make periodic payments throughout the year. Now, here's the important thing to remember. If the government puts this in writing, you have an obligation to respond. Now, I'm choosing my words carefully. It doesn't mean that you have to make a payment. It does mean, though, that you have to take their request under consideration and determine whether the amount they've asked for is warranted. If you're on mat leave, as an example, in the year that follows and you've made $250,000 in the previous year, and CRA sends you installment reminders, they do it twice a year. They will do it in the first, usually January and February, because there's an installment date on March 15th, and then July, August for the second half of the year. That's when they typically make their written requests to taxpayers. If CRA has not put a notice in your portal, your CRA portal, or if they've not sent it to you by mail, you have no obligation to make installment payments. Out of an abundance of caution, I will do a calculation on every tax return to see if there's installments due. Sometimes CRA misses a written request, and if they miss it, then you don't have an obligation to pay. But I want to make certain that you have an idea of how much tax you need to be paying next year. Now, here's what oftentimes happens. We file a person's tax return. They have a balance owing of $90,000, let's say. I'm just making that up. But they owe $90,000 at April 30th. And they think to themselves, and CRA has been doing this recently, they will say, well, you can make that payment by a certain date. Or people will get my letter, or they'll get a notification from CRA, and they'll look at it and goes, okay, that's the amount I saw on my income tax return. That's the amount I owe. Therefore, they must be giving me a payment plan here. They must be saying, I guess I can pay this balance on June 15th and September 15th and December 15th upcoming. No, that's not what they're saying. If you owe $90,000 on April 30th, you have to pay $90,000 on April 30th. And if you don't, they will start to charge you interest on that balance. That balance pertains to the previous year. And so in that case, they want their $90,000 and they want it no later than April 30th. Now, if you owe CRA more than $3,000 at April 30th, then that should trigger them looking to see or looking to do a calculation for installments. They're saying, we're willing to let it go up to $3,000, but not more than that. And if that's the case, then they will come out with a calculation of installments. Those installments are for the current year. The April 30th balance was for the previous year. So it's quite possible that you could end up paying tax for 2 years within 12 months if you look through the calculations, because the calculation for the installment is based on your previous year's income. And so they're going to look at that and say, all right, well, if they made this amount in the previous year, we want the same amount this year. Now, if you make more income next year, you don't have to pay more than they have advised in their installments. If you're making less and they tell you to pay more, you don't have an obligation to pay the amount that they've asked for. You should do a calculation of your own to figure out what tax you will owe and then pay that. And as long as you do that, you won't have any penalties for deficient installment, or I should be more precise, you won't have any deficient installment interest. Okay, now we've talked about what an expense is and how to claim it. And so that's part of what this slide is. I mentioned, and I'm just going to reiterate here in terms of the importance of claiming expenses, because on the slide that you can see here, you can see, for example, we're using the province of Ontario, and I've mentioned the figure of $220,000 previously, but you can see here that once your income hits $220,000, the amount of tax on that income is a flat tax of 53.53%. So that's more money spent in tax on that dollar than you actually keep. which is why your expenses are so critical. You'll see the statistic on screen that when we get clients coming in, new clients, healthcare professionals, more than 90% of the returns that come to us from prior years get amended because things have been missed. There are so many expenses people aren't aware that they could have claimed in the past. Oftentimes I will hear somebody saying, oh, my tax return was so simple, I did it myself. Well, actually it wasn't, and that just cost you a lot of money. It cost you a lot of money in deductions because you were spending a ton of money on your training. And so though many of those expenses can be claimed, and they can be claimed in the future. We don't want to claim an expense if we can help it when you're earning this kind of income right here. When it's low, there's no advantage to claiming it when it's low. There's every advantage to claiming it when it's high. So if we have the type of expense that is a discretionary expense, we'll push that off and claim it in a future period. An example of that would be an RSP contribution. You put money into your RSP, you want to start saving for the future, but at the same time, your income is low. In a case like that, the deduction of that contribution is discretionary. So we want to use our discretion to your advantage. All right, so that's a little bit about how much money to set aside and expenses and why it's important to use our discretion when claiming expenses. Now, let's talk about future cash management and why that's important when it comes to identifying your living expenses. All right, so we have got the question of how much do you need to retire at the top of the list. And that's because I can't think of a more important question to ask a new to practice physician. Because, and I'll give you a real life example. This has happened a couple of weeks ago, and particularly since we've seen interest rates on the rise, those that have debt are now starting to feel the pinch of interest. This was a family, both are physicians earning in excess of $700,000 a year combined. And so, but have a mortgage in the neighborhood of about $3 million. Interest rates went up recently by a full percentage, and it's likely they're going to go up again. And so if they fix their mortgage rate, because they're currently on a variable basis, their mortgage rate will be a little over 5%. Do the math. $3 million times 5% is $150,000. And that is just the interest. They are not paying down a penny of their mortgage. They're just treading water. And on $150,000 at their level of income, they're having to earn more than double that just to make those payments. So, you know, a significant amount of their income is going just to service debt. Well, why am I talking about them? I'm talking about them because if they had taken some time to think about the first order of priority once they started practice, which was how much do we need to save for retirement, then they would know each month we need to be setting this amount of money aside, and then what's left over is available for lifestyle. That didn't happen in this case, and I'm certain we are going to see more and more people who are affected by this because of large lines of credit from the past, as well as large mortgages from buying homes. So cash management is critical, and the three big questions to ask: how much do you need for retirement? How much do you need for monthly living expenses? And then debt and obligation repayment, having a time frame for that. All right, so how much do you need to live on? Sometimes I see people go through like incredibly detailed spreadsheets of how much they need, down to, I don't know, how much they're spending on cell phones and their monthly internet and so on. And if you're that type of person, and if that works for you, great. I find more and more that I deal with people that don't necessarily have a background in finance or personal finances and don't know where to start. And so I say, don't go too crazy on the details. Let's just start with the information that's readily available. This should take you 45 minutes. And so I'm giving you a time budget on this because I don't want you to feel like this is a huge job. This should be this can be done in, as I say, 45 minutes and give you a good feel for where you're at. So how do we do this? Well, on screen is what I call a back of the envelope calculation of monthly living expenses. I've done it in a spreadsheet. You can do it on a piece of paper. But you can see here what we've got set up is 5 months. And in the past 5 months, here's the amount of money that's been coming out of the person's personal bank account. So the first place to start on your bank statement is at the bottom of the bank statement itself with total withdrawals. Write that number in as the first number. That's how much came out. That's how much money was spent. But then there's some adjustments we need to make in order to get at your actual living expenses, because your cell phone and your OMA fees and your CMPA dues and any of those practice-related expenses are not living expenses. Those have to do with earning your income. So pull that out, all right? So that's the first item to remove is practice-related expenses. The next is one-time purchases. Maybe you bought some new furniture, a new car, a rent, you paid for exam fees upcoming. That is not a recurring living expense. Put that down. That's in this month, number 2. And then finally, if you're paying down debt, then pull that out. We will come up with a separate plan to address that. We just want to know what your living expenses are. All right, with me so far? Now, once you've done that, and with respect to getting the one-time purchases, by the way, you are going to have to go to your credit card statement as well, because when you look at the total withdrawals include your payment of your credit card, but your credit card total is a total of a number of purchases. So you're going to have to look on your credit card statement for those one-time purchases and those practice-related expenses in order to pull them out, because they're buried in the credit card statement, which is paid through one payment per month. All right, once you've done this, and you can see in this case, you've now arrived at what that living expense is per month. Now, simply take an average of it. In this case, the average monthly cost to live was $6,200. That's what the person needed to live on. Now, if they need $6,293, let's round it up to $6,300, and that's actually about $75,000 a year. Now, that's after tax. So if we're going to figure out what they need to earn, pay the tax to be left with $75,000 or $6,300, we have to figure out what that gross amount is. In this case, the amount that person would have to earn in order to net $75,000 is about $107,500. And so that's the amount of money that this person needs to cover their living expenses. Now, why is that important? Well, it's important because if you're trying to figure out how much money you should set aside for retirement, you've got to have an idea of how much you're earning and what your living expenses are to see whether you've got enough money set aside to save for retirement. And we'll get into how to calculate that in a slide or two. But this is also helpful when you're trying to determine, do I want to incorporate or not? Because if you're earning $220,000 or more and you really only need $107,000, then maybe you want to consider incorporating. All right, but that's the significance of this slide. All right, now we talked about whether you wanted to incorporate, but what about for retirement? Now remember, back here we were looking at somebody who needed $6,300 roughly. I've used $6,000 in this scenario, and the purpose of this exercise is to say to a new to practice physician who wants to know how much they should be saving each month, then, all right, what are your living expenses at present, and when do you want to retire? In this case, the person wants to retire somewhere between 50 and 55. They're age 33, so we know how many years they have to save between age 50 and 55, 17 and 22. So they've got a relatively short period of time to amass a base of wealth that will generate enough interest income to replace their active income that they're earning from the practice of medicine. In this case, what we do, just to explain this spreadsheet, is we start out with the monthly estimated amount to live on, $6,000. We know that's $72,000 for the year. And then I've applied a tax factor to that of 23%. That's the inverse of the 77%. So they really need to earn, in this case, about $94,000. If they pay into Canada Pension Plan, then presently CPP is paying out about $14,000 a year. So they will have to earn about $80,000 in investment income. Now, I always say to people, let's work backwards with this. 79,500 divided by 0.03 gives you 2,650,000. We do it again, a second calculation, only this time we use 4%, and that reduces the amount needed for retirement to 1,987,000. So why am I using 3 and 4%? Well, when you retire, you don't want to take chances with your money. You're going to invest your money in safe investments. And so that's why the rate of return on safe investments is low. So you need to take that into consideration in order to determine how much of a pot you need to grow in order to be able to retire on the living expenses that you have at present. That's the theory. In this case, it's somewhere between call it 2 million and 2.6. So we picked 2,318,000. Now, that's how much will be needed for retirement. In this case, if somebody has some assets already, like their registered accounts, their registered retirement savings plans or TFSAs or things like that, then we take that out. Notice in the calculation below, it doesn't include the house. You're going to have to live somewhere. So that we consider to be separate. In this case, this person still needs to be saving $2.23 million in order to hit retirement. Now, let's break that down into a monthly amount, assuming they're earning 6%. That is going to translate into either $6,565 if they retire at age 50, that needs to be saved every month, and they continue to earn 6% annually and contribute that amount each month. Or if they want to work an extra 5 years, it drops down to $4,245. But that's the type of exercise to determine right out of the gate how much money you need to be saving to make sure you've got enough saved for retirement. All right, we talked about expense tracking. I'm going to skip over this for sake of time because I think I'm running a little bit late. And so I want to talk a little bit about whether or not it makes sense to incorporate or not. And so, as I mentioned earlier on, by default, you are a sole proprietor if you haven't incorporated. And so you report the income you've earned on your personal tax return and you pay tax on that. And so that will have implications for your cash flow because as we saw earlier, if you owe a large amount of tax this year, you're going to have to pay that tax next April. And then it's likely CRA is going to look to you to make the same amount of tax paid again if you continue to earn the same or more. And they're going to want the same amount of money next September and December. And so if you owed 90 in April, you're going to owe 90 again. That's $180,000 of your cash gone for tax. So you can see the structure that you find yourself in has cash flow implications. Now, there is no extra costs involved with being a sole proprietor. You don't have to go to a lawyer and register to be a sole proprietor. You are that by default. And the date of reporting your income is on a calendar year basis. So on your tax return, it runs from January 1st to December 31st each year. And so those are that's a description of what it means to be a sole proprietor. And so the impact of tax, both now and future installments, can have a significant impact on your needs for cash if you're looking to pay off debt or, say, for example, buy a house. So that's the default position. The next is incorporation. Now, incorporation isn't for everyone, and there's cash flow implications for that. You have to pay to set up an incorporation. It'll cost you $1,000 with a lawyer, and then depending on the province you're in, you'll have to pay a certain fee for a certificate of authorization. That needs to be paid as well. In Ontario, that's $400, so you're up to about $1,400. And by the way, don't do that on your own. There is a temptation to do that. OMA, for example, offers a service. It's cheaper than a lawyer. I think it's about $600 now. So that's an option as well. but there is a cost to set this up. And then the other considerations that you want to are set out below. Where will you be practicing medicine? So if you're in Ontario, but you do a locum in BC or in the Northwest Territories, for example, that income is being earned out of province. That income can only be earned by you personally. It can't flow through your corporation. So another consideration about whether to incorporate or not. Now, if it's a small amount of income, then fine. You might need income, so the rest of the income you earn goes into your corporation, and you live on what you earn from those locums, or that forms part of your income for the year. And then whether or not you're a U.S. citizen. Now, there is a myth that says if I'm a U.S. citizen, I shouldn't incorporate. It is not true. We have lots of clients who are U.S. citizens who are incorporated, but it does mean that there are a few factors to take into consideration, because you're also going to have to report that income on a U.S. tax return, and there's implications for that because the U.S. taxes things differently than Canada does. So again, a consideration. And then, do you own shares in another corporation? I ran across this very thing today. A client who's just set up their own professional corporation didn't think to ask, did they still own shares in their father's professional corporation? Their father was a physician also. Turns out that this person, when they went on to their provincial body, their regulatory body, went on and discovered that they still were registered as a shareholder of their father's corporation. They have now associated those two corporations, or that's how it appeared. And so that creates a tax problem. If you're going to incorporate, you want to make sure if your parents had their own businesses, their own corporations, that you're not a shareholder of them. And then the types of income you'll be earning. This is a consideration. If you're an employee of a hospital, that means you're getting a T4 slip. That means you're withholding CPP, EI, and income tax. You can't incorporate. You can't flow that income through a corporation. So what type of income will you be earning? And can that income flow through a corporation is another consideration. And of course, I've talked about the costs of incorporating as well. So you $1,500 to set it up, and then there's the ongoing maintenance of the bookkeeping and the filing of the corporate tax return and preparing financial statements and so on is a cost involved in that. All right, so we have a previous webinar on this topic that's recorded. So feel free to go and watch that for more information on this, but I'm going to keep moving on. You'll find this at that URL. All right, some other useful information. What to do if CRA contacts you. I mention this because oftentimes we will get inquiries from CRA. A couple of very common ones is somebody has made an online payment to pay their tax, and their payment has gone to the wrong year. They get a notice of assessment from CRA saying they owe $90,000, and they call us quite exercised because they say, but I've already paid that $90,000 and the government isn't giving me credit for it. Well, that's because the money was applied to the current tax year and not to the previous tax year where the debt sits. So if we're in 2022 and they've made a payment in 2022, it's likely that payment should have been applied against 2021. It just needs to be moved. And so we get dozens of calls around that. And then what to do if CRA contacts you with a question? Well, first you have to ask yourself, is this actually CRA calling me? Because there are a lot of scams out there which are trying to get your information. So be careful about that. If CRA contacts you or somebody purports to be with CRA, don't answer their questions and tell them, I'm not going to answer any of your questions because I don't know who you are and this could be a scam, but I will call the 1-800 number and ask if CRA is actually trying to contact me. And so that's the preferred response to avoid giving information, confidential information out to a total stranger. Remember, CRA will never ask you for your social insurance number. They will never ask for a credit card. They will never ask for immediate payments over the phone. And if you encounter a call like that, you're likely encountering a scam. I always say also, do not send information to your accountant or any tax advisor, investment advisor, or to the bank by email, have it uploaded by a secure portal. Oftentimes when somebody's buying a house and they need information for a mortgage financing, we will liaise with the bank and create a portal and upload that information on behalf of the client so they don't have to keep going back and forth for it. So those are some things to keep in mind with respect to fielding CRA inquiries and transmitting information. All right, so we've talked about a client portal, avoiding using emails and so on. Here's some additional resources that you might find useful either for sourcing work or information like Health Force Ontario. There was a publication called New in Practice. It was a CMA publication. It's only available, or it was only available to CMA members online. So if you're a member of OMA, I think you're a member of CMA automatically. That was a great resource in terms of just additional information like the information we've had here this evening. And then for tracking kilometers, I didn't talk about this too much. I didn't talk about this part of keeping track of your auto expenses, but in order to claim your auto expenses, you must keep track of your kilometers because the expenses are prorated. If you drove 80% of the time for work and you're self-employed, you can claim 80% of the expenses. But CRA does require a log to be kept, and that can be an onerous task unless you use an app. I use an app called MileIQ. It sits on my phone anytime I move, irrespective of if I'm in my wife's car or my car, it keeps track of that trip. Great tool. So in terms of systems you've gotten out of tonight's session, the expense tracking worksheet and using your credit card to keep track of expenses. And the second system is MileIQ for keeping track of your kilometers. And then if you want other videos, the last item on screen there is about our previous webinars that have been recorded. I think that is all the content of tonight's slides. I hope you found that useful. I don't know, Mustafa, have there been any questions that have come in? We've run a little bit over time.
No questions so far, but if anybody has any questions, please post them in the question section and I'll read them out.
Thank you. And in the meantime, if you'd like to get in touch with me for a complimentary next steps meeting, feel free to do so. It's a complimentary 1-hour meeting to give you some more content, some more ideas on where you're at, or to see what your next steps, what best next steps are for you. And if there, well, we'll just leave the chat open for another moment or two. Upcoming in the month of October, 5 ways of taking money out of your corporation is the next webinar. And then in November and December, we will be talking about the taxation of investment income. There's a lot of confusion around investment income and how it's taxed. So that's a lineup of our upcoming webinars. So feel free to register for those once you receive an email, or pass the email along to colleagues who you think might find it useful. Mustafa, anything? Any questions?
We have one question here. Where could they find the retirement calculator?
Oh, if you send me an email, I will. I can send you that calculator, but I would probably, just because it's proprietary, and also because the information and the calculations in there can be a bit technical. You probably don't want to try that one on your own, but send me an email and I'll certainly plug in the numbers for you and give you a calculation and explain the assumptions. Anything else?
No, looks like that's it for today.
All right, thank you everyone for joining us. I hope you found this useful, and I look forward to seeing you inside of our next webinar. Thank you for your time today. Take care now.